the loan can be either fixed rate loan or it can be a floating rate loan. Okay, the loan can be a fixed rate. So the loan can be a fixed rate loan. In that case, what will happen? The interest rate will be determined at the very beginning, and throughout the loan period it will be maintained. Okay, so fixed rate loan is a loan with a rate of interest that is determined at a set increment above the prime rate. So let's say you go to the bank, to take a loan. After assessing your company, the bank has determined that your rate will be prime rate 5%. So your rate will be 5% plus 3%, that is equal to 8%, and this fixed. So if you take the loan for 6 months, you will just pay the interest at the rate of 8%, at annual rate of 8%. We are not talking about the calculation yet. So this is the fixed rate loan. It will not change. Okay, it will be set at the very beginning and it will be maintained until the loan period is end. It will remain unvarying, okay, until maturity. Okay, this is called fixed rate loan. Now let us talk about a floating rate loan. Okay, so floating rate loan is a loan with a rate of interest initially set at an increment above the prime rate. Up to this it is same, but it is allowed to float or vary above prime as the prime rate varies. So what happened in this case? Let's say your if it is a floating rate, okay. Now let us see what changes are expected. So if it is a floating rate, then what will happen? The rate is set as prime rate plus 3%. So at the beginning of the loan, let's say you have taken the loan in January 1. So on January 1, the rate was 5%. So your rate is, prime rate was 5%. So your rate is 5% plus 3%, that is 8%. But you will repay the loan on June, at the end of June. So after 6 months, when you try to repay, at that time you have to see what is the prime rate. If the prime rate increases to 6%, then your rate will be 6% plus 3%, that is 9%. Okay, so it will actually depend on the changes of the prime rate. If the prime rate changes, you will have, if the prime rate increases, then your applicable rate will be higher. If the prime rate decreases, then your applicable rate will be lower at the time of payment. Okay, so floating rate loan varies, okay, as the prime rate varies, but fixed rate loan does not vary. It is fixed at the beginning of the loan period.